later, starting Monday, September 10th, all through the week.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Mehta. Let's welcome our expert there, Sangeet of Newberry Capital and Yogesh Mehta of Motilal Oswal Securities join us on the show. Today on Hot Money, we'll discuss stocks like Muthoot Finance, which came out with numbers and has been rallying ever since. It rallied 9% yesterday. It's rallying almost 5% in trade today. We'll talk about the mid-cap IT space. Most of the mid-cap IT stocks are doing well in trade. Even a strong commentary that came in from Mindtree post the analyst meet, and the counter is doing well. Media as a pack is not doing well. Today, Z is down in trade. Sun TV has actually seen and fallen to almost a 52-week low. So there is enough negative traction on that counter. And finally, the last stock that we want to talk about is one stock that, in the fall that we've seen this week, quite a few heavyweights are down almost 10 to 15%. So is any of the stock worth accumulating at this point of time? So those are the stocks that we'll talk about. Let's start with the first one, and that is Muthoot Finance. Came out with strong set of numbers. Yesterday rallied significantly. What should one do? We'll ask our guest. So Yogesh, how did you all analyze the numbers and what did you make of the numbers?
For Muthoot Finance, number have come yesterday, Darshan, and we are also excited about the numbers. But somehow we saw that the average ticket, which has went up to now 39,000 from or earlier 36,800 odd, and the bigger way was the outperformance which came is from the subsidiaries with the Home Finance and the Belstar. So all these have done very well, and we see that the cost of funding has decreased substantially, and GNPA has come down to almost now 4.6%, which is a 240 basis points of reduction. So all in all, that package of Muthoot Finance and the demand post-demonetization is growing, of course. So that has given a tailwind to them, and cost of funding, which was very lower on this quarter. So combination of these 3-4 factors have delivered better performance on this absolute number, and the ticket size, the AUM has also grown up to now 310 billion. So we believe that overall it's a good numbers, but upside is very much limited. So we are giving a neutral stance on that.
Okay, have you all changed any kind of target price on the numbers post seeing it? What are you recommending your investors?
For Muthoot Finance particularly, we have upgraded the estimates for FY19 and FY20, but it is very marginal one. So earlier it was 460 as a price target. Now it stands at 490 rupees.
Okay, so another potential 45 rupee upside on Muthoot Finance. What about you, Sangeet? What did you make of the numbers?
So slightly positive to neutral, I would say. Personally, I don't like gold finance business as such. It's a business wherein you lend for a very short tenure. So essentially, you want to sustain growth, you need to add on new customers every year. Having said that, 90-95% of the book of Muthoot Finance is gold finance. NPA is not at all a problem in this business because it's more than adequately collateralized with a liquid asset. I like the other businesses which they are doing now, but it forms a very small portion of their total book, which is microfinance and Belstar and insurance broking and a Sri Lankan subsidiary, also a small subsidiary that they have. Valuations are too compelling. That's why my stance is little neutral and not bearish. It just trades at about 2 times, and if you see price to earnings just about 8 to 9 times, and being the market leader and no problem of underwriting as such due to the quality of asset which they leverage. I'm neutral to positive on this stock.
Okay, just a couple of follow-up questions. What are the key triggers if someone wants to, let's say, take a position? What are the key triggers that this company has to do that probably your stance will change on the positive side for Muthoot? And there are 2 large gold companies. One of them is Muthoot, and second is Manappuram. Among them, do you prefer either one of them? Do you like Manappuram better than Muthoot, or you're neutral on both of them?
No, my neutral stance comes from the basic business which they do, which is gold finance. So essential quality of the business is short-term loans, and to sustain growth, you will have to add on new customers every year, So it's nothing against Muthoot, or it's nothing against Manappuram as such. So I remain neutral purely because of the valuations. Had the valuations been, say, 3 or 4 times book, I would have been bearish on the stock.
Okay, that's the view that's coming in on Muthoot Finance post the numbers. Not too much optimistic views that are coming in. It's a more like a neutral view that's coming in. Motilal Oswal sees a potential 45 rupee upside on the counter, and that's because they rolled over the estimates of the company. Finally, the second stock that we want to talk about is mid-cap IT. Mid-cap IT actually did manage to outperform the large-cap IT, then took a break, and again the rally seems to have been continuing. Most of the mid-cap IT counters have been doing rather well. Mindtree in its recent analyst meet gave a very positive comment. But what stock in the mid-cap IT space do our guests like? We'll ask them. Sangeet, anything that you like in the mid-cap IT space?
So mid-cap IT space looks interesting. However, one space which market has not taken into consideration is within the mid-cap IT space is the product IT companies.
Okay.
Now, there are three of them largely in the listed space. The biggest is the Oracle Finance. There is one Excelsia Kale, and the third is SQS BFSI. Amongst the three, I like Excelsia Kale. I think it trades about 985 now. It's trading at about 15 to 20% discount to what Warburg paid last year to acquire this company. And dividend yield is close to 5.5%, 80% is the payout ratio. Cash generating business, they don't need any capital as such for business. So it's a great company to be invested in. I see very limited downside from here on. You have a big currency tailwind as well coming your way. It's basically a proxy play on the aviation growth worldwide. So they are the market leaders in providing Rivera, which is their prime software, to the airline companies. Unfortunately, the growth has not been there for last couple of quarters because couple of airlines globally has gone bust. The last one was I think Air Berlin, which they lost as a key customer last quarter. But having said that, being a market leader, I think water will find its own level, and I think the growth should return.
Any reason why the counter has corrected so much in the near term?
So the last quarter results were not too healthy because of Air Berlin, which they lost out. Also, they are also in a transition because Warburg bought this company last year, and Warburg Pincus also owns Mercator. So now this becomes a group company which earlier were rivals, sort of. So now that synergies are being worked out, and it's now going to be one company. So I think that transition is taking a bit of time. So hopefully we should see the growth back on track.
Okay, so that's the view that's coming in on Excelsia Kale. Yogesh, in the mid-cap IT space, what do you like?
In mid-cap IT space, we like many stocks, but with the valuation comfort now, we believe that Persistent System, it's a very conservative kind of a stock, and they're basically into enterprise solution, IT, and product, largely into a little bit of services. So overall, transformation and the enterprise business are doing well. Digital, we are betting very high on that because digitalization is taking now next step over globally. The only thing is right now the dependency of the total business of Persistent is 43% by IBM. There's a marquee client for them. But we believe that overall the pricing power, the capability of the management all together, and we believe that they have done the capex for last 3-4 quarters, which will pay back them over now next 2 years. So that should give more visibility into that. Digital in last quarter was subdued, but enterprise has taken over. So that has given an offset on the results. What we believe is that digital will take forward further is 46 rupees EPS for this FY19, and due to digital improvement in the business, we believe 56 or 58 rupees would be the EPS for the next year. So it's a very conservative stock with 15% CAGR returns over next 2-3 years that can easily be achievable.
Okay, you said what was the target that you all have suggested?
The target is 950 rupees as of now based on FY20 EPS of 56 rupees.
Okay, recently I think Persistent was one of the companies which actually downgraded its revenue. I'm not sure which, but there was a phase where they had said that it won't be able to achieve. Are there such risks that are still visible on Persistent?
There is a perception of the people that everybody is guiding for the next quarter or for next financial year. This management is very shy and they don't give away any kind of a guidance for the next year or next year. They believe in deliverables and rather than guiding them. So whenever we spoke to the management, they have guided for 15% or sub 15% kind of a growth rate, and they achieve over and above that.
And how does it compare in terms of valuation compared to the peers? Most of the peers have run up.
Yeah.
Persistent hasn't run up as much as the peers. So in terms of valuations, how would that be compared to its peers?
In these, I think again at 950 rupees, it will be valued at FY19 basis 20 times, and for FY20 basis, if we see, then 56 rupees, and current price is 830 odd somewhere. So still it is there is some more room to go above this level. So Mindtree, we like it very much, but then fair valuation will remain at around 1200 rupees, not much upside than current level of 1150. Even we like NIT Tech, even we like Tech Mahindra, but then upside remains very, those are fairly valued right now.
Okay. So in terms of valuation,
in terms of valuation, now this is the only one company which has remained that, you know, upside will be there as a conservative investor.
But any reason why it has not been able to catch up to, why it's not participate so much in this IT rally?
Because if you see that the difference, main difference would be that Mindtree has outperformed the Q1 and the Q4 results both together, and the management guidance was much more ahead of the estimate of the analyst. Here, Persistent has not delivered up to that extent in Q1. It was very subdued results. So that's why it's a laggard one in terms of, you know, running of the stock prices in peer comparison of an NIT Tech or maybe a Mindtree or the Hexaware.
Okay, just one question on you. You said that you're like product companies. So the three companies was Oracle, SQS, and Axelia. Is there any direct competitor to Axelia as far as the Indian peer? Is there any Indian peer that, you know, matches up to Axelia in the terms of business that they do?
No, the next competitor for Axelia was Mercator. Now both have come into the Warburg's fold. So essentially, they are the market leaders collectively now. There is no Indian peer.
Has Warburg, because Warburg usually, you know, runs a business and then, you know, it exits it at a high level. Has Warburg given any kind of indication that they would want to, you know, move out of this business? What's the commentary that Warburg has given in terms of growth for Axelia?
So it's just last year that they've acquired this business.
Yeah, from Axelia, right?
From the earlier promoters.
Yeah.
And the open offer was at 1250 rupees. The price right now is trading at around 985. You know, being a private equity player, I would assume that they would wait for 3 to 5 years before even looking at exiting a business. You know, and Warburg paying 1250 for an open offer and share price even after 1.5 years available at 15% discount gives a lot of comfort on the valuation bit also.
Okay.
You know, so no commentary by Warburg as such about their exit. I think it's too early for them to even talk about exit. You know, so we'll have to wait and see how the business pans out. Then we'll talk about exits.
Okay, and on the other two companies on the product side, any comment that are you all bullish on that, or would you be?
That also looks interesting. Again, a very heavy dividend yield company. Both the companies don't require capital to grow, so they are returning back capital to the shareholders. The dividend yield again is in the range of 4 to 5%. However, growth is a little concern, I would say, in terms of Oracle and SQS, because they have not been adding new clients per se. So it's more like a stable cash generating companies that you want to buy. And if you want to buy equities, you would generally seek to buy growth. You know, so if there is no growth, then you know, I would might as well invest in a debt product than an equity. Yeah.
Okay. So that's the view that's coming in on the IT stocks. Axelia, Kale as well as Persistent Systems are the two stocks that have been discussed in this part of the conversation. The next one is interesting. It's the media space. Now today, Zee Entertainment is down almost 7 to 8% the last time I saw when Morgan downgraded. Sun TV itself has been on a downward spiral. It's trading at a record 52-week low. So there is something that's plaguing Sun TV. There's some issue as far as the media sector is concerned. What's the issue? We'll ask a guest, and what's the view on Sun TV? We'll ask. So, Yogesh, what's gone wrong with Sun TV? It's corrected massively. It's not that there was some issue as well, but are you aware of what probably is the reason?
Probably the reason could be they have got a market share as a leader in the South genre with Malayalam and Telugu and Tamil all together. So now it is getting competition from the different channels like, you know, Gemini, the Udaya and the Star. So all these are giving competition to them, and the incremental revenue subscription they have got is around 400 million. So that they have got 8 million kind of in Telangana, in Tamil Nadu. So that they are planning to increase that by 10 to 15% in this financial year and 15% further in FY20. So that's the management call. Plus the new channel lined up are also there. But Apart from competition, nothing has gone wrong. Management has cited for 2.5 rupees dividend last year, and now they are increasing 5 rupees for this year. So their payout has also increased. They have done capex in terms of movies. They are doing a more innovative in the channel of Bangla. They are now venturing into that. Bangla channel will start in maybe somewhere in November or so, and one more Tamil movies channel they are launching, and that will attract the youth. So everything is fine, and probably any external reason would be there, but we are not aware of apart from the competition, if there is any.
As a house, what are you all recommending on Sun?
We are betting very high on the media side, and we like Sun TV most than Z, but Z has corrected today. But otherwise, in terms of valuation, we are betting much higher on Sun TV rather than Z.
Okay, that's the view. So Sun over Z at this point. I'll come back to you, but your view on Sun TV, what seems to have gone wrong?
So I am not liking the counter. I think the major issue has been the market share losses. So about 18 months back, they used to command about 60% market share in the south. You know, and if you see now, this market share has dropped considerably to about 47%. They have lost out the market share to Star, Vijay, and Zee Tamil specifically. You know, so that's a big. Never in the history we have seen Sun TV's market share dropping below 50%. Also, I think the management has been a little slow to adapt to technologies. You don't have a OTT, OTT platform as yet, you know, which the other players have launched. I'm also very, reluctant in the sector because it's more prone to disruptions. We have just seen, maybe just 1% or 2% impact of the disruptions, but the disruptions that could come through the OTT, segment could be immense, on the pure play traditional broadcasting segment. So not very exciting space to be in, I would say.
Okay, so you're basically negative on the entire media space as such, or only Sun TV? Would that include Zee also?
Yeah, because Zee, again, valuation is a concern. Sun TV, another concern is being, closely linked to the political family. The promoter's salary, if you see, is 175 crores, if I'm not wrong, which is, I'm not able to justify such high payouts to management. So I remain cautious on the entire sector as such.
Okay, are these valid concerns what he pointed out? Because some of the point, let's put across the remuneration, which actually is a big part. But market share below 50%, don't have an OTT platform. So are these valid concerns?
These are valid concerns, and even we have also mentioned as a risk factor or the valid concern in our report as well, that 175 crores is remuneration for FY19. They have continued the same for next financial year, that is this financial year. In 18 also the same. Plus there is a movie channel they are launching, and there again the capex of 420 crores they have projected for. So these all are valid concern, plus external reason on the political connection that could be one of those key important risk factor where people or investors will not like those companies where there is affiliation by the political leader. So these are very much valid concern over there. But what we are projecting, apart from the external reasons, that yes, the one-off 175 crores is the remuneration. Apart from that, we don't foresee that they are very much capable of having that remain into the competition for a prolonged period of time. It is not that they'll get obsolete into the competition.
Okay, so that's the view that's coming in on the media sector and Sun TV. And the final stock that we want to talk about, most of the high quality names have fallen anywhere between 10 to 15% in the last few trading sessions. Some of the stocks have become much cheaper and attractive than what they were. Is there any stock in this pack that our guests like and would like to recommend for a slightly longer term perspective? We'll ask our guests. So Sangeet, counters have come off significantly. Valuations for some counters have become much better than what they were. I'm not saying they become rather cheap, but if you had to take a bet at this point of time, which counter would you say?
So there is one mid-cap company called as Wonderla Holidays.
Okay.
It's into operating theme parks. They operate about 3 theme parks in India. One is in Bangalore, Cochin, and Hyderabad. They also have a resort in Bangalore. The stock has fallen from around 450 levels to about 300 now. That looks interesting. They own the real estate in all the theme parks which they operate. It's a zero debt company. They generate about 100 crores cash every year, and it's again a pure play on the consumer discretionary spending, and a pure operating leverage play also. So I like that space.
Okay, but what's it's trading near a 52-week low. It's falling every day. What seems to be the trouble that the market is having with this stock?
So one is last year when GST regime was introduced, they were grouped under 28% GST. Which is with the sin goods. Fortunately, the government realized and they have now changed it to 18%. So that's a big positive which has come in the last quarter. The footfalls have not increased as expected, though the Hyderabad park, which they opened last year, is doing fairly well. But the older parks of Cochin has not been doing so well. I think those are the two concerns which largely the street has. But I think very astute management, if you see the historically, the way they have been operating is they opened one park. So they started with Cochin somewhere in I think 99 somewhere. With their profits, they started the Bangalore one in somewhere in 2003, 2004, and with their profits, they started the Hyderabad one, last one. So very conservative kind of management. They intend to open a Chennai park soon, but that's gone into some bureaucratic hurdles. So I think that's another concern which the street has. The Chennai park management earlier had guided, it should have been up and running by 2019 sometime. But that's not going to happen because that's run into some political or bureaucratic hurdles as such. So yeah, I mean those are the concerns.
Okay, and this GST that's got to down from 28% to 18%. Is it still a big hurdle? Why? Because footfalls are not happening. This is even 18% considered to be too high as footfalls are not happening?
No, I wouldn't. I think 18% is a fair rate. I would say so because it kinds of matches with the service tax rate or the entertainment tax, whatever was applicable last time. And this rate reduction has happened sometime in April, I believe, of this year. So some benefit was captured in the first quarter results also.
Okay.
But I think it takes a little time for the consumers to digest the new pricing and all. They've reduced the pricing now, the ticket pricing and all.
Okay, and valuation-wise, how does this pan out, and does it require a lot of capex because entertainment parks are high capex?
So yes, it requires capex, but essentially these are maintenance capex once the park is up and running. And unlike ad labs, they haven't resort to any debt finance which they cannot sustain. Trades at about 11 times EV to EBITDA. Important part is they also own a lot of real estate in and around the park which they are operating. So that also gives a lot of comfort on the valuation. The book value I think is about 150 if I'm not wrong, and trades at about 300. So valuation is a good comforting factor. We just need to see when the growth comes in. Big part of growth will also come from the merchandising, which in India has traditionally been on the lower side as compared to globally. So as and when that share increases, plus ticket pricing as per the inflation and all that, that should give the growth.
Okay, Wonderla is a stock that Sangeet likes at this point of time. Yogesh, which stock do you all like at this point of time and recommending to clients?
Many a stock have corrected off late in this week at least. But we like the most is like Eicher. It was Bosch as well, but Bosch has now run up after 10% post that EV segment. We like Eicher Motor the best right now because it was laggard for last 1.5 years post a fantabulous run up. Management has changed their focus to product and innovation into that, and the new capacities they have done in sync with the capacity expansion and the demand. They are planning for opening new stores. Currently is 880 and they are planning for 950 850 to 950 in this financial year. Globally, they are having 37 stores and the dealership network is 950 projection. What we believe is that the new innovation and the product launch in between greater than 250cc to 650cc in between segment, which is catching more fancy now. So they are planning to venture there. They've already announced that. The new Interceptor and the Continental they have announced that is also doing fairly well now. Globally, between 250 to 650cc, the demand is very high because it's a Pro Series bikes. Okay. And right now, the sale is around 1 million annually. Right now, RE is doing something like 18,000 exports. So post this capacity expansion, they are planning for at least 18,000 to 36,000 over next 1 year. And 1.5 year down the line, they will be doing something like more than 40,000. So that they are projecting for. The dealership network expansion is already been in place, and that will give kicker to them. So what we believe is that post-correction now, and the new JPKQ is now yet to be launched. They have announced it recently in last week. So that is also given a fancy, and that will take some sale more towards currently 70,000, 71,000 odd per month to at least 73, 74,000 over for this rest of the financial year. And for FY20, it will be something like 79 to 80,000.
Okay.
So that 15% growth rate and the new launches, which will catch a premium, putting all this together, there is a still uptick in the growth is visible for this company. And it was not like, okay, company has been running on a single model of Royal Enfield, and then there's an innovation of slightly more chroma or the metal type of the cosmetic change. But they have done technology change and now venturing into that.
Okay, so basically this is the RE model. Are you all, what about the CV model that comes in? How much value are you all giving to that?
For that CV, we are projecting Excel norm will not have any material impact on the overall business. So there we are giving CV and a combination of these two would be 80-20 right now in the ratio of 80 to 20, and combination would be there. Earlier it used to command 40 times PE multiple. Currently it is quoting at around 30 times PE multiple over FY19, and FY20 would be around 1235, would be 23 times price PE multiple. So we believe that there is a fairly large upside is there. And
what's the target that you all have?
Target right now we have 34,000 odd on the higher side, and currently it is quoting at 29,000.
So it's another 5,000 rupee upside.
Another 5,000 rupees upside is there.
Is that because I think for Aisha the street concern was that the supply demand mismatch, which was clearly in favor of demand over supply, with the new capacity coming in, that will actually shrink and the multiple will come down. It's already come down, but is that a valid concern now going ahead? Earlier, this excess capacity.
Yeah, the excess capacity is there, but they are forcing growth into that demand with the new launches, as I mentioned. And the waiting period was 6 months earlier last year, then it went down to 3, and now it is 1 month only. So that the waiting period is also lower, so that will create the demand more and more, and the supply will catch up.
And what's the pecking order that you all have for the two-wheeler space?
That is something that we are variable on, because we are doing that annual manufacturing capacity vis-a-vis the orders they have are matching right now. So we are just working on those numbers as of now.
Okay, no problem. We'll talk about that. But those are the stocks that's been spoken about. Wonderla Holidays is something that Sangeet likes, and he's given his rationale. And Aisha Motors is something that Yogesh likes at this point of time. But with that, it's a wrap on today's Hot Money. Yogesh, thank you so much for coming in. Sangeet, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.